Hi, it's Andre with American California Financial. If you click the video link to watch this information, it's probably because you want to learn about equity lines of credit. So I'm going to go through or share my screen with you and show you what is good and bad about equity lines of credit. Now, I think equity lines of credit are probably some of the most beneficial products out there for the right person at the right time and for the right reason. And we're going to kind of go through the good and the bad of it. But we'll just start with what a HELOC, and that's the acronym for Home Equity Line of Credit. Also, sometimes they use the acronym ELOC, which is Equity Line of Credit. The same thing. It's a Home Equity Line of Credit. And let's just go through some of these items so you can get comfortable with it. As I mentioned to you, I think an equity line of credit is really, really good for the following reasons. They are extremely cheap to originate. Basically, if you shop hard enough, most of the big box banks will have an equity line of credit, either relatively cheap or free. They give them away, used to give them away like candy, but they give them away as a foot in the door so they can sell you other products, whether it's checking, savings, car loans, credit cards, and stuff like that. So they're loss leaders for the big box banks. I have noticed recently that banks are starting to charge. So you could see banks starting to charge anywhere from $1,000 to $1,500 to get one. But if you look hard enough, you should still be able to find them for free. Second option or second reason I think they're a great product is they're super flexible, because if you don't have a balance, you don't pay anything in the way of interest. So they're like a credit card in the sense that, again, if you don't have a balance, there's no charge and there's no interest that is due at the end of the month. Unlike a credit card, equity lines of credit or HELOCs, for the most part, not always, are interest-only payments for the first 10 years. So again, this is one of those things that I've noticed have changed in the last 6 months to a year. But if you, again, look hard enough, we still have lenders that offer them with interest-only payments for the first 10 years. After the interest only period, and that's also the draw period where you can, charge your line and then pay it off, charge your line. We call that the draw period. It's for the first 10 years. After that, it turns into a 20-year fully amortized adjustable rate mortgage. Most of the equity lines of credit have a low start rate, albeit usually for only a teaser period of 1 month to 3 months. I think they're absolutely dynamite to have as an emergency fund. So if you have an equity line of credit behind your first trust deed, it is a great emergency fund, because if you have an emergency with like a loss of a job or illness where you can't work for 3 or 4 months, you can use the line of credit to hold you over. You don't have to, start a loan. A lot of times, if you lose a job or something like that, you wouldn't qualify for a new loan. So it's a great emergency or a rainy day fund to have available for you, at least for the first 10 years, because during that time, you can use it for that reason as you please. So let's talk a little bit about some of the bad sides or the downsides to an equity line of credit. They're not usually explained very well by the loan officers because they're trying to sell you a product, but you definitely need to know about them. First one is it is always an adjustable rate mortgage. So you may have a teaser rate or start rate for a month or 3, but after that, it will adjust to an index plus a margin. We're going to go through those two terms in a minute. But bottom line is that the rates can go up or down. They will go up or down over the next 30 years. So you need to kind of understand how that works and how volatile it is. Most equity lines of credit, if not all equity lines of credit, because I've never seen an equity line of credit that does not have a life cap of less than 18%. So while your start rate might be very, very low, the interest rate can go all the way up to 18%. Not that it would, but it could. There are no annual caps on most first trust deed adjustables. there is what's called an annual cap or a 6-month cap or some sort of period cap that protects you from the rates rising too quickly. So for instance, most adjustables have either a 1 or 2% annual cap, which means that if your start rate is 3%, it could not go more than 5, 3 plus 2 would be a 5% increase. Equity lines of credit do not have annual caps, which means that they could in 1 month go all the way to 18%. Chances of that happening are slim to none, but just understand that it could happen per the terms of the agreement. The other thing you need to understand is that unlike some other adjustables, the index, which is the basis for your rate, and we're going to talk about index and margin in a minute, but the index that equity lines of credits use is prime rate. Prime rate is a volatile index, which means it moves quickly and it can move more repeatedly or more often than other indices. So an index is a measure of the economic well-being. It's a measure of inflation. For instance, I know the index that you probably most likely have heard of is CPI, which is the Consumer Price Index. It is a measure of inflation. Other indices that may be tied to loans are the COSI, the coffee, 1-year T-bill. Those are typically an average of the last 12 or 6 months. But prime rate is a monthly figure that adjusts whenever the banks have a higher cost. And the prime rate is actually what banks charge their best customers. And for the reason that prime is usually not enough, they add a margin to that. That would be an additional profit on top of whatever prime is, because you're not a business or a large company like Google or Ford. So they usually charge a margin on top of the index. So if it's prime plus 1, then you take whatever prime is. Today, as at the time of this recording, prime is 3.25. If your index is 1, you add prime plus 1, or 3.25 plus 1 equals 4.25. And the reason I say, and we're going to get into some of the best practices, I'm going to say shop margin, is because the margin is what ends up determining your rate along with the index. All right, so we'll talk about that in a minute. Annual fees, you need to know that annual fees are anywhere from $0 to $500, depending on the lender. So that's something I would shop for. Closeout fees, usually banks have a closeout fee if you pay off and close the line. You can always pay off the line, you just can't close the line. But if you do close out the line, there is usually some sort of fee to do that in the first 3 years. So let's talk a little bit about best practices. All right, when you're going to shop margin. As I mentioned, the index is pretty much set. It's going to be prime, so whatever prime is. But the margin is that additional profit that the bank will charge you because you're not a large company. So prime can be anywhere from 0 to 3 or 4%. So obviously, if you have 0 as your margin, then it's prime rate 3.25 as of today, plus 0 means your rate is 3.25. If you have prime plus 1, 1 being the margin, then it's 3.25 plus 1, 4.25. If it's prime plus 3, then you do prime 3.25 plus 3 or 6.25. So as you can see, the margin is very important. I know it may be a little confusing. Call me, I'll explain it to you if you have any other questions. Shop fees, as I mentioned to you, a lot of times lenders do not have fees, but more and more banks are now starting to charge fees to open up a line of credit. So ask about that. The other thing you should shop for before we get into the next bullet point is closeout fees. Yeah, those are the 3 things you want to shop for: margin, fees, and closeout fees. Some of the best practices, if you have a small loan that you can pay back quickly, equity lines of credit are dynamite, especially for small loan amounts, because the fees are so low to originate or get the line of credit. Great for short-term loans, mainly because if you can pay back the loan quickly, you're not going to be at risk of having the interest rate rise too much in a short period of time. So if you're going to pay this loan back in 1 or 2 years, it's a small loan amount. Small is relative to different people, but let's say a $20,000 line of credit for a small kitchen or bathroom remodel for 1 year because you're going to pay it back quicker. That's an equity line of credit is a great way to go. Again, for all the aforementioned reasons, flexibility, being cheap, and so forth. Pay off the balance quickly. I already discussed that. Wonderful for an emergency reserve. As I mentioned to you, if you keep the line at 0, there are no charges. You just hold on to it. If you get laid off or lose your job, become sick, you will not have time, nor will you qualify for a new loan. You just go tap that equity line of credit for the next 2 to 3 years while you get your affairs in order. All right. Some alternatives to HELOCs, loans from family. If you're lucky enough to have a rich family member, why not pay them interest? They make some money. It's it's easier for you to get the loan. You don't have to go through all that paperwork hassle. Fixed second trust deeds. This is a great alternative. We have options with lenders for both equity lines of credit and fixed second trust deeds. The big one there is that your fixed second trust deed is just that. The interest rate is fixed for the term of the loan, whether it's 15, 20, or 30 years. If you can afford the payment today, you can afford the payment for the term of the loan because they will not change. New cash out refi. If you weren't lucky enough to lock in some of the record lows, we could do a new cash out refi, pay off your current first at a higher rate or a rate that's very similar, and then do cash out again under a fixed rate. You would get the benefit of a new first trust deed. Some banks do personal loans. Those are usually from anywhere from $3,000 to $10,000, higher rates of interest. And there are usually not any fees associated with that, but be careful because a lot of times those are also adjustables. Credit cards, cheap and easy to get, very expensive to keep because the rates on credit cards are anywhere from 12 to 15, 18%. And they do wreck your credit if you load them up. All right, I think that's it. If I can talk to you about anything we've talked about today or go into deeper details, the next slide is going to have my cell phone number. Please call me. I'd love to get into anything else that I can help you out with. We're always here for you. And yeah, I'm going to see if I can, here we go. So yeah, call me. Refer your family, friends, do that. After you watch the video, there should be a link if you want to subscribe to the channel. Have a great afternoon. Thanks for watching. And again, call me if you have any questions. All right. We'll talk soon. Bye-bye.